So in this video, I want to give you advanced knowledge of EPS. Earlier, I had made a video on EPS. It's a very interesting, very valuable video. Please watch that. Okay, in the thumbnail, you will see EPS written in bold letters. Watch that video. Here, I want to give you some advanced understanding of the EPS. Now, why am I so hung up on EPS and EPS growth? Because if you study 125 years of stock market data, the most crucial determinant of stock price movement in the past has been the growth in EPS. Okay, the growth in the EPS determines the movement of the stock prices. Over and over again, you will see that if the EPS is growing, the stock price will grow. If the EPS is declining, the stock price will decline. Over and over. This is 125 years of stock market data, and this is well documented by William O'Neill in his book How to Make Money in Stocks. So that is why this is my second video on EPS. So please pay attention to what I am saying here. Okay, this is very important. It is very important that you understand what I am going to explain in this video. Okay, so let's say in Q1 of 2024, okay, the earnings of the company, earnings means profit after tax. Okay, so let's say the earnings of the company is $100 million. I'm using dollars because uh, this YouTube channel has a global audience, so I'm using dollars. Okay, then then number of shares outstanding is 10 million. So Q1 2024, $100 million is the earnings. 10 million is the number of shares outstanding. Okay. What is the EPS? EPS is 100 million earnings per share. Okay. So 100 million divided by 10. 10 million. Okay. So that's 10. 100 million divided by 10 million shares or 100 million of earnings distributed over 10 million shares is $10 of EPS. Now, on the other hand, if you see, if you go to Q1 of 2025, go 1 year ahead. Now the earnings are 150 million. Okay. Number of shares are 15 million. So basically, during this year from Q1 2024 to Q1 2025, the company has issued 5 million shares. Now, why does the company issue 5 million shares? Okay. Because the company wants to raise money, they want to raise capital, they will use that capital to invest in projects, do capital expenditure and things like that. Instead of taking a loan from the bank, they will sell 5 million shares, and in exchange for those 5 million shares they will get money from the market. Okay, so the number of outstanding shares of a company, which is always limited in supply, the supply of the shares has increased. So now what is the EPS? The EPS is 150 million in earnings divided by 15 million number of shares outstanding. So 150 million divided by 15 million. Okay, that's again 10 EPS. Now look at the earnings growth. What is the growth in earnings? Now, when I say earnings, I'm talking about profit after tax. Okay. After paying all the expenses and taxes, whatever you get is profit after tax. That is the earnings. What is the growth in earnings? The growth in earnings, if I write here, see earnings growth is equal to 50%, right? What is EPS growth? Is what is EPS growth? Is 0%, right? So earnings, although earnings have grown by 50%, the EPS has grown only by 0%. And what do you think matters more? Earnings growth or EPS growth? It is the EPS growth that matters the most. Okay. This is extremely important point. It is the EPS growth that matters the most. So although the earnings have grown, the net effect on EPS has been zero. Why? Because for the company to make extra 50% of earnings, they have had to issue shares, they have had to dilute their shareholding. Okay, imagine you own 5 million shares of this company. Just imagine You own 5 million shares of the company. You are a 50% shareholder of the company. Okay. Now suddenly the company issues shares to the market. Now it's 15 million. Now you are not a 50% shareholder. Now you are a 33% shareholder, because out of 15 million, you only have 5 million shares out in your pocket, right? So earlier you had claim to 50% of the profits of the company. Now you have claim only on 33% of the profits of the company, because your shareholding has been diluted by issuing new shares. So always look at the diluted EPS of a company. So if you look at, let's say, for the Indian market is very simple. They directly give you the EPS growth. So I will show for American markets also how to look at this number. So if I go to Keynes Technology, okay, you go here, you click on consolidated, you look at this number. It's directly they are giving you the EPS. Okay, directly you get the EPS. But on for people who are outside India, let's say you're trading NYSE, Nasdaq, let me select a stock. Let's say Skyward. I had discussed this stock earlier. You go to Skyward, you go click here, go to fund financials, statements, income statement, go down, go to diluted earnings per share. Okay, diluted earnings per share. Look at this number. This is the latest quarter. Okay, 56.57% growth. These are the numbers that you should be looking at. Okay, earlier we would look at the net income number. Okay, net income, see, it is 68% growth, but EPS growth, diluted EPS is 56%. So diluted EPS growth is smaller than the net income growth. So that means the company has probably issued some shares to make money. Okay. So always focus on this number, not this number. Of course, this number is important because you want the profits of a company to grow. But focus on this number. Now, this is one scenario. The company has had to issue shares to raise money to increase its earnings. Now look at another scenario. Okay, let me take this table and create another table. Okay. So it is Q1 2024, 100 million in earnings, 10 million shares outstanding. So $10 is the EPS. Now you go to 2025. Let's say the earnings are 100 million. Okay. And the number of shares is 5 million. Now what is the EPS? Now the EPS is 100 million divided by 5 million. That is 20 million. So what happened? What happened here? Let's go to earnings growth. Something crazy happened here, right? Look here. Earnings growth is what? 0%, because 100 million to 100 million, the earnings growth is 0%. What's EPS growth? The EPS has gone from 10 to 20. That's 100% growth in EPS. So how is it possible that the profit of the company has remained stagnant, but the EPS has doubled? How is it possible? Well, in this case, the reverse has happened. The company, instead of issuing shares, the company has so much of cash that they bought back their shares in from the market, right? Which means the number of outstanding shares has actually gone down. So even though the profit has not improved, the EPS has doubled. Okay, so let's say out of 10 million, you have 2 million shares in your pocket. Okay, you own 2 million shares. You have a 20% shareholding in the company, right? Out of 10 million, the company uses its cash reserves to buy back 5 million shares. Okay, so now you have 5 million outstanding. Out of 5 million, how much do you own? 2 million, which means now earlier you used to own 20% of the company. Now it is 2 million out of 5 million. So now you own 40% of the company. So earlier you had claim to only 20% of the profits of the company. Now you have claim on 40% of the profits of the company. That's brilliant, right? So earlier, you as a shareholder, you had stake to only $20 million. That was the earnings that belonged to you because you own 2 million shares. Now, out of 100 million, you are entitled to $40 million in earnings. So even if the profit has not grown, your shareholding has improved in the company. That is why Warren Buffett is a big fan of share buyback. Okay. So even if the profit doesn't grow, your stake to the profits of the company, your claim on the profits, it increases. So this is an ideal scenario. So what's the difference between these two companies? There is a big difference between these two companies. This company doesn't have money. It has to raise money from the market to increase its earnings. So it has to dilute its existing shareholding. Okay, this is a company which is in trouble. In this case, this is a company which doesn't need to raise money because it has so much cash that it can buy its own shares and increase the shareholding of the existing shareholders who want to be with the company for a longer period of time. Okay. So just by looking at the numbers, just by looking at earnings growth and EPS growth, you can quickly come to know which company is better than the other. So it become your position sizing, your stock selection becomes very refined if you start to look at EPS and earnings in this way. One point you should note is the sometimes what companies do is they artificially reduce their shareholding. So they will borrow money from the market, from the bank, and use that money to buy back its own shares. So this EPS is artificially propped up. Okay, for the for the stock price to improve because shareholders look at stock prices. Stock market participants look at EPS growth rate. Okay, so some companies borrow money and they use that borrowed money to buy back their own shares. That is not ethical. Okay, if a company has bought back its own shares, the first thing you have to check is, has the company borrowed money? Has the company raised money from the market to buy back its own shares? If that is the case, that company should be out of your watch list. Reject. Okay. However, if the company has not raised outside money, if the company is flush with cash and it is using a certain percentage of that cash to buy back its own shares, that's a company that you should be paying attention to. Okay, that's a company where I would be happy to violate one or two of my rules here and there just to get a small position in that company, because that company is doing the right thing. It is using its capital effectively. Another thing to note is that if the shares are expensive, okay, then it doesn't make sense for a company to buy back its own shares. Imagine a company where the shares are, the valuation is too out of whack, okay, and the company continues to buy back its own shares. So in such cases, there is a problem. The management does not understand valuation. They have just decided that they will buy back the shares and the EPS will grow and the shareholders will come. Okay, all the stock price will go up. However, if the shares of the company are expensive, it is better to use that capital to grow the business rather than buy back shares of the company. Because when you buy back shares of a company, the cash from the business goes out of the business. Okay. So cash is important to be held. When the company shares are cheap, when the valuations are cheap, then it makes sense to use your capital effectively. Okay. It's like you're buying back your own shares, so you are showing more confidence in your own company. That's a good sign. So just by looking at the numbers, you can come at some fantastic conclusions. This will refine your stock selection process. This will also alert you to companies that are buying back their own shares. Look at whether they are raising outside money or they are buying back shares with their own cash. So that company should come on your radar. And if that such a company gives a nice EPS growth, strong base, strong buy point, technically, fundamentally, comparatively strong, that's a candidate for your watch list. That is a company which is worth your time. Now, the opposite of share buyback is a stock split. So a company has, let's say 10 million shares. Suddenly this 10 million becomes 100 million because the company splits the share of a company. So the shareholding remains the same, but the number of shares have increased. Okay, so the earnings remains 100 million, but now 10 million becomes 100 million shares because there is a stock split of the company. So for every one share I have, I will be entitled to receive 10 shares. So that one share will get cancelled and I will get 10 shares I will have 10 shares in the company in exchange for that one share. So now 10 million shares has become 100 million. Okay. So now earlier the EPS was 10. Now the EPS has become 1. Okay. See, this doesn't mean that the EPS has declined by, 90%. That is not, see, nothing has changed in the companies. A stock split and a share buyback are different. In a share buyback, there is a genuine increase in the EPS of the company. I get my shareholding is improved. But in a stock split, what is happening is, although the EPS has declined, okay, it has gone down by 90%. Okay, this might sound crazy, but now I am entitled to 10 shares, right? Earlier I had one share. Now I have 10 shares of the company. So I am 1 multiplied by 10. I still have 10 in the company, right? 10 EPA. 10 rupees is what I have claimed to. What do you say? Not per share, but overall shareholding. So stock split does not affect me as a shareholder in terms of percentage shareholding, but a share buyback definitely does. So you will see Warren Buffett getting excited about share buyback, but he's not excited about stock split as such because it doesn't change much. Okay, so that's why I call this video as EPS Pro. You have to become a pro on understanding EPS. Okay, EPS is the most crucial determinant factor as far as stock price movement is concerned. William O'Neill and company, they found by studying 125 years of stock market data is that the most important factor for stock price movement is the growth in the EPS, the quarterly growth, the annual growth in the EPS combined with accelerating sales growth, decent sales growth. Okay. So I hope you understand this video. If you find this video confusing, if you have any questions, just send me your questions. I will either make a video to answer that question or I will make a podcast episode. Okay. I do have a podcast, by the way, where I take questions asked in the comment section of my YouTube channel. I take those questions and I give answer to those questions on my podcast. So if you are, going for a morning walk or a evening walk, or if you are in the gym, uh, please keep listening to my podcast. Some of your concepts will get cleared there itself. There are some questions where you don't need to look at the chart. Okay. Thank you so much for your time. Thank you so much for your support. Have a fantastic day today.